Hey everyone, welcome back to BullionIQ, your go-to place to break down everything happening in the crypto and finance world. I'm so glad you're here because today we're diving into some of the hottest updates that are shaking the markets right now. Whether you're a longtime crypto holder or just starting out, there's a lot to unpack, so grab a coffee, sit back, and let's get into it. We've got some incredibly interesting insights coming from some of the biggest names in the space: Charles Hodgson, Elon Musk, CZ from Binance, and even Ray Dalio. Each one of them is highlighting trends and shifts that could impact not just XRP or Bitcoin, but the broader crypto ecosystem. And trust me, understanding these moves now can put you ahead of the curve before the mainstream catches on. Let's start with a concept that's been making waves across the markets: demand versus supply. Chad posted something recently that perfectly sums it up. Demand is persistent, supply is limited, and history shows us exactly what happens in these situations. Look at gold. Central banks started buying it heavily from 2022, adding about 1,000 tons each year. Yet gold's price didn't truly spike until this year. Why? Because when demand exceeds supply, it takes time to work through those who are willing to sell. The same principle is playing out in crypto right now. With ETFs launching for Bitcoin, Ethereum, and Solana, the demand is crushing the new supply. Once the holders who are ready to sell run out, we could see massive upward moves similar to gold. That's the potential pattern for Bitcoin, XRP, and other major assets in 2026. Now let's talk specifically about XRP. Ask yourself this: are you selling XRP at current prices? If you bought it at 30 cents, 50 cents, or even $1, how much have you really gained yet? The real catalyst isn't short-term price action, it's institutional adoption. The infrastructure is being built behind the scenes. Once institutions start moving heavily into XRP, the market could react in ways that retail traders can't fully anticipate yet. I'd love to hear what you're thinking in the comments below. Are you holding, adding more, or waiting for a specific trigger? Your perspective matters because this is exactly the kind of market where timing and strategy can make a big difference. Switching gears, let's consider what CZ, the founder of Binance, has been highlighting at Davos. He mentioned three major future themes in crypto: tokenization, payments, and AI agents. These are not just buzzwords, they're tangible areas where crypto is becoming integrated into real-world systems. Tokenization means governments and institutions can digitally represent assets, opening new financial opportunities. Payments refer to bridging traditional spending with crypto behind the scenes, making transactions seamless. And AI agents, they could eventually use crypto as their default currency for performing real-world tasks. This shows how crypto is evolving beyond speculation into actual infrastructure that powers our daily lives. At the same time, there's a lot happening in the regulatory landscape. Charles Hodgson has been talking about politics, recessions, and the macro forces shaping the U.S. economy. Trade wars and shifting partnerships with countries like China, Canada, and the UK could create serious pressures. While some see this as just politics, the reality is that these moves directly affect market behavior. Consumption patterns, investment flows, and the global financial web are all intertwined. For crypto investors, understanding these macro trends is just as important as following on-chain data. And here's the big takeaway from all of this: the crypto ecosystem is maturing. We're no longer just dealing with random hype cycles or meme coins. We now have adoption metrics, institutional interest, and government interaction shaping the future of these assets. MAUs, TVL, and transaction volumes are healthy, even if valuations sometimes lag expectations. This is a sign that the infrastructure is solid, and when the next bull cycle comes, it could be more sustainable and more explosive than what we've seen in previous cycles. Finally, let's not forget Ripple. The Clarity Act and Ripple's potential banking license are two major catalysts. If approved, Ripple could become one of the most well-capitalized banks while still holding XRP, creating enormous leverage in the ecosystem. This isn't just speculation. It's about seeing how real-world regulations and banking approvals intersect with crypto markets. And as someone following this space closely, I can tell you this is the kind of development that separates long-term winners from short-term players. So that's where we're at today. Demand-supply dynamics, institutional adoption, tokenization, AI, and Ripple's regulatory milestones are all converging. It's an exciting, complex, and potentially very profitable moment for anyone paying attention. I want to hear from you. What do you think about the Clarity Act, the banking license, or Elon Musk's AI ambitions? Drop your thoughts in the comments because this conversation is just getting started. And as always, if you're enjoying the breakdowns here at BullionIQ, hit that like button so we know you want more insights like this. Let's talk about demand and supply again, because this is at the core of what's happening with XRP and other major crypto assets. Whenever demand exceeds supply, prices don't just move instantly, they follow a process. Historically, we've seen this with gold, and now we're seeing it with Bitcoin, Ethereum, and XRP. ETFs have created a situation where new supply is being absorbed almost immediately. Institutional investors are slowly taking control, but retail sellers are still on the sidelines. The result is a slow, steady buildup that eventually leads to significant price movement. This is why XRP hasn't exploded yet despite strong interest. It's all about the timing of institutional flows. Now let's get specific about XRP adoption. Right now, many holders are wondering, should I add more XRP or is this the right time to sell? The answer isn't simple because the market isn't only about current prices, it's about infrastructure and utility. Ripple is building partnerships with banks and financial institutions globally. The Clarity Act, once passed, will accelerate DeFi adoption and bring a lot of traditional financial services onto the XRP ledger. This means XRP isn't just a token to hold, it becomes a key part of financial operations for institutions. When that happens, the market reacts in a very different way compared to regular retail speculation. Let's talk ETFs for a moment. ETFs are a game changer because they allow institutional money to flow into crypto without actually holding the coins directly. This reduces risk for big investors and increases demand for the underlying assets. Think of it this way. The ETFs are creating a steady, predictable demand curve while supply remains limited. This combination is exactly what leads to large price spikes once early sellers are exhausted. XRP, Bitcoin, Ethereum, and Solana are all in this stage. Once the OG holders step back, the next wave of institutional buying could push prices much higher than we're seeing now. Another critical point is macro factors and global adoption. Charles Hodgson highlighted how political tensions, trade wars, and shifting international alliances can indirectly affect crypto markets. For example, if traditional financial systems face constraints due to geopolitical factors, more capital flows toward decentralized systems like XRP. It's not just speculation, it's a hedge against uncertainty. Investors who understand these connections can position themselves ahead of the curve. XRP is particularly interesting here because Ripple is already working with governments and banks, giving it a real-world edge over other crypto projects. Let's also touch on use cases beyond speculation. Payments, tokenization, and AI integration are transforming the way cryptocurrencies are used. Stablecoins have been the first major step, offering a bridge between crypto and traditional currencies. XRP and other major assets are moving into areas like cross-border payments, banking settlements, and even AI agent transactions. Imagine a future where AI agents can transact automatically using crypto on behalf of humans. This is not science fiction. It's already being developed. Ripple, with its banking partnerships and XRP ledger infrastructure, is well positioned to benefit from this shift. One of the most important points to understand is market maturity. Early crypto cycles were driven primarily by hype and retail speculation. Now, adoption metrics matter. Metrics like TVL, total value locked, MAUs, monthly active users, and transaction volumes are the indicators of real market health. Even if the price hasn't spiked yet, these metrics are showing that the ecosystem is robust. This is why professional investors are watching XRP closely. They see the foundation being built for a more sustainable bull market rather than short-term pumps. Institutional adoption also ties directly into regulatory clarity. The Clarity Act and Ripple's banking license are the two biggest catalysts here. A banking license means Ripple can operate with full regulatory approval, manage XRP liquidity more efficiently, and integrate with the broader financial system. This would make XRP not just a crypto asset, but a functional financial instrument for institutions. The combination of ETF inflows, regulatory clarity, and real-world utility is what could trigger a major price move in 2026. Finally, let's talk about the community perspective. Are you holding XRP for the long term or watching the charts daily? This is the moment to think strategically. Selling now might seem tempting if you bought high, but the real gains often come from infrastructure-driven adoption. Institutional flows, regulatory milestones, and utility integration will be the main drivers of the next bull market, not short-term hype. Engaging with these insights and understanding how these macro and micro factors connect is what separates casual traders from informed investors. So to summarize this part, the market isn't just about current prices. ETFs, limited supply, institutional adoption, and regulatory clarity are all converging to create the conditions for the next big move. XRP is uniquely positioned to benefit because of Ripple's banking partnerships and infrastructure development. The takeaway is simple. Watch adoption, watch regulatory progress, and think long-term. This is the foundation for understanding not just XRP, but the broader crypto landscape in 2026, Elon Musk and Tesla's humanoid robots, also known as Optimus. Musk recently highlighted how these robots will be capable of performing real-world tasks in industrial and public settings. At first, they'll handle simple operations in factories, but by next year, they could handle more complex tasks and even start being sold to the public. This is important for crypto because AI and robotics will create demand for digital payment systems that are faster, automated, and borderless. Imagine a world where robots or AI agents can pay for products or services using crypto. XRP, with its fast and low-cost transactions, could naturally become a preferred option in these scenarios. This is not just speculation, it's the logical outcome of integrating crypto with AI-driven systems. Next, let's discuss tokenization. CZ from Binance emphasized that tokenization, payments, and AI agents are major themes for the future of crypto. Tokenization allows governments and businesses to represent real-world assets digitally. Think of a building, a stock, or even commodities being represented as tokens on a blockchain. This opens huge possibilities for liquidity, trading, and accessibility. Instead of traditional intermediaries slowing down transactions, tokenized assets can move instantly, and XRP's infrastructure could play a major role in facilitating these transactions. The efficiency of the XRP ledger, combined with global banking connections, positions it well for adoption in this area. Payments are another key area. Traditionally, crypto hasn't been widely used for everyday spending, but we're starting to see the convergence of traditional payment systems with crypto. For example, someone could swipe a card and the underlying payment could settle in crypto while the merchant still receives dollars or euros. This creates a seamless bridge between fiat and crypto, opening adoption to millions of users. XRP's fast settlement times and low fees make it ideal for this kind of integration. As payment infrastructure develops globally, the demand for reliable crypto like XRP will likely increase significantly. Let's also touch on AI agents and their native currency. Currently, AI systems don't transact independently. They can't book a hotel or pay for services autonomously, but that is changing rapidly. The native currency for AI agents will likely be crypto because it allows fast, programmable, and borderless payments. As AI adoption grows, these agents will need a secure, fast, and universally accepted digital currency. XRP's low-cost, high-speed transactions make it a natural fit. This could create a new wave of transactional demand, not driven by retail traders, but by real-world usage from AI-driven systems. Now, it's important to understand the macro implications of technology adoption. Charles Hodgson mentioned that political instability, trade wars, and global shifts affect how and where investments flow. If traditional financial systems face pressure, capital may move into decentralized and tech-driven systems. Technologies like tokenization, AI agents, and crypto-enabled payments could absorb a lot of this capital, creating a strong foundation for XRP and other major digital assets. The convergence of technology and crypto isn't just theoretical, it's creating tangible market trends that professional investors are starting to notice. One more critical point is regulatory clarity combined with technology adoption. Ripple's banking license and the Clarity Act are going to accelerate the integration of XRP into real-world financial systems. When tokenized assets, AI payments, and crypto infrastructure meet regulatory approval, adoption can scale exponentially. Institutional players will have confidence to participate, and retail investors can benefit from broader adoption. This alignment of tech regulation and financial integration is a powerful signal for the market. We also have insights from BitGo and BlackRock about the long-term strength of cryptocurrencies. They highlight that while Bitcoin pioneered the space, the next wave of growth comes from use cases built on crypto technology. Tokenized equities, DeFi applications, stablecoins, and AI-driven transactions are all examples. The more mainstream these technologies become, the more critical assets like XRP are for executing transactions efficiently. Investors who understand the interplay between technology adoption and crypto infrastructure will be better positioned for the next bull market. Finally, remember Ray Dalio's warning about fiat losing trust and the breakdown of the traditional monetary order. As capital flows shift away from traditional systems, demand for fast, reliable, and globally accepted crypto increases. Technologies like AI agents, tokenization, and blockchain-powered payments create the infrastructure that makes this shift possible. XRP, with its unique combination of speed, scalability, and institutional integration, could see enormous growth as these trends converge. Charles Hodgson has been speaking about several critical issues affecting not just traditional markets, but crypto as well. One of his main points revolves around potential recessions in the United States. With trade tensions rising, tariffs being imposed, and global alliances shifting, the U.S. could see a slowdown in consumption. Since our economy heavily relies on domestic consumption and exports, losing trading partners or facing retaliatory tariffs can reduce both demand and capital inflows. For crypto investors, this is significant because macro uncertainty often drives capital into decentralized assets like XRP, Bitcoin, and other digital currencies as a hedge against traditional market risk. Hodgson also highlighted how countries like Canada, the UK, and India are increasingly partnering with China, partly in response to US trade policies. This realignment has consequences for capital flows, supply chains, and international investments. For crypto, this means more money could move into decentralized finance and digital assets as a safeguard. Investors who can see these trends early can anticipate where liquidity might shift, making assets like XRP particularly interesting. Ripple's global banking partnerships could benefit directly from this because cross-border payments and settlement systems will become increasingly relevant in a fragmented global economy. Another important macro factor is the role of institutional regulation and market interference. Hodgson mentioned how past events, such as government interventions and debt crises, have affected crypto cycles. While retail investors often react to price movements, institutions and regulators play a huge role in the background. ETF launches, central bank policies, and government regulations are all forces that can accelerate or delay market trends. Understanding these undercurrents gives us an edge in predicting which assets, like XRP, are positioned to thrive when adoption and demand eventually collide. Now let's focus on adoption metrics because they tell a story beyond price. Total value locked, TVL, transaction volumes, and monthly active users, MAUs, have all shown healthy growth despite macro disruptions. This indicates that the ecosystem is maturing. Even if the market doesn't spike immediately, the infrastructure is robust. This aligns with what Hodgson mentioned. Projects that integrate with mainstream financial systems, such as Ripple with banks and payment networks, are more likely to succeed long-term. The days of meme-driven pump-and-dump cycles are giving way to a market defined by adoption, utility, and regulatory compliance. Hodgson also touched on crypto politics, particularly the dangers of pay-to-play systems. In the past, certain regulatory decisions required lobbying, donations, or patronage to succeed. Hodgson argues that regulation should be based on market size, economic impact, and real adoption metrics, rather than political influence. For XRP investors, this is a key insight. When regulations are aligned with market fundamentals, assets with genuine adoption and infrastructure, like XRP, are likely to see long-term growth, while projects that lack substance may struggle or fail. Let's also consider historical market cycles. Hodgson noted that while adoption metrics are strong, the U.S. government and macro events often delay market spikes. Examples include unexpected interventions, debt crises, or October surprises that temporarily suppress valuations. For XRP and other major assets, this means patience is key. While the infrastructure is strong, external shocks can create temporary stalls in price growth. Savvy investors recognize these pauses as opportunities to accumulate rather than moments to panic. Trade wars, tariffs, and shifting alliances are not just theoretical. They impact consumption, investment, and capital flows. The U.S. is seeing its traditional partners move closer to China and Russia, which changes global economic dynamics. If half of the U.S.'s trading partners redirect their capital, domestic growth slows. This macro risk often pushes investors to alternative assets, including crypto. For XRP, Ripple's banking license and cross-border settlement capabilities make it well-positioned to capture capital moving away from traditional fiat systems. Finally, Hodgson emphasized that the combination of macro uncertainty, strong adoption metrics, and institutional engagement sets the stage for the next bull cycle. Projects with robust infrastructure, regulatory alignment, and real-world use cases will outperform the rest. XRP fits this description perfectly. By understanding how macro forces interact with adoption and technology trends, investors can make smarter, more informed decisions, rather than reacting emotionally to daily price movements. This is one of the most significant regulatory developments for Ripple and the XRP ecosystem. Once passed, it will define the relationship between traditional finance, TradFi, and decentralized finance, DeFi. Essentially, it accelerates the transition of banks and institutions onto blockchain-based systems. For XRP, this means the token isn't just a digital asset, it becomes an integral part of financial operations. Institutional adoption will follow because companies and banks will have clarity on legal and operational frameworks. This is not just speculation, it's a structural shift that can influence market demand and long-term value. Next, Ripple's banking license is another major milestone. Being approved as a bank allows Ripple to operate fully within regulated financial systems while holding significant XRP reserves. This dual functionality is unique. Ripple can use its XRP holdings to facilitate liquidity, payments, and cross-border settlements, while also benefiting from traditional banking operations. The market impact of this cannot be overstated. It gives XRP legitimacy in the eyes of institutions, reduces counterparty risk, and provides a bridge between digital and traditional finance. For investors, this is a clear signal. XRP is moving from a speculative asset to a utility-driven financial instrument. Now let's consider price catalysts. Historically, major price moves in crypto have been triggered by adoption, regulatory clarity, and macro shifts. We've already discussed how ETFs, limited supply, and institutional flows create natural upward pressure. Adding Ripple's Clarity Act and banking license to the mix, we now have a scenario where regulatory approval and real-world utility converge. Once these milestones are achieved, we could see a substantial increase in demand for XRP, especially from institutional investors who have been waiting for clear rules and frameworks. This could be the green light moment for the next major market move. Another key factor is integration with emerging technologies. We've seen how AI, tokenization, and automated payments are rapidly evolving. XRP's infrastructure is uniquely suited to take advantage of these trends. Imagine AI agents conducting financial transactions in real time, tokenized assets being settled instantly, and cross-border payments being executed with minimal fees. These are not distant possibilities. They are being implemented now. As adoption increases in these areas, XRP's utility grows, and with it, the potential market demand and valuation. It's also important to consider the macro environment. Trade tensions, global capital shifts, and monetary uncertainty can all drive demand toward decentralized systems. Ray Dalio's warnings about fiat losing trust and capital wars highlight the increasing importance of crypto as a hedge and store of value. XRP, with its real-world financial integrations, is positioned to benefit more than most. Investors who understand these macro trends can anticipate demand surges even before they hit the broader retail market. Let's not forget market psychology and community behavior. Early holders, or OGs, have a significant impact on price dynamics. Until their willingness to sell decreases, supply remains constrained. Once institutional and retail demand grows in combination with reduced selling pressure, we can expect the kind of sharp upward moves that resemble past cycles in gold or Bitcoin. XRP is entering this phase right now, which makes it a potentially strong candidate for major growth in 2026.